What if I told you you can pay off your mortgage 5 to 10 years faster without making bigger payments? You see, most Canadians are stuck paying hundreds of thousands in interest on their mortgage over 25 years because they simply don't know this strategy exists. It's called an offset mortgage, and it's one of the most underutilized tools for paying down your mortgage faster. And the best part is, with this strategy, you don't need additional cash flow, you don't need to increase your payments, and you just need to restructure how your money flows. So I'm going to break it all down in this video with a snippet from my previous webinar, and we're going to cover exactly how it works, the long-term numbers, who this is for, and who it's not for. Let's go. Traditional mortgages, typically they have you choose between two different things. First thing, liquidity, so the cash available, which means maybe they opted in to extend their amortization, to bring the payment down, to have more of that flexibility, which is fine. That works in that works in a lot of scenarios, a lot of cases for people. That's one method to free up cash flow. Or they wanted to aggressively pay off their mortgage by shortening the amortization. That's an example where you're sacrificing your lifestyle by having a higher payment, but it means faster mortgage payoff. But what if you could have both? Eat your cake and eat it too, liquidity and the mortgage payoff. The traditional mortgage setup, I'm going to show you two different setups. This is the traditional way that all of us are used to. We have our payment that comes in from our paycheck, it flows into your checking account. Then from there, a portion of that money goes into either your savings or your investments, hopefully. And the other part goes to expenses and mortgages and your mortgage payment. So that's the typical flow. Payment comes in, goes through the checking, and then you kind of divide that money and it goes wherever. And that's just the traditional mortgage setup. That's what we're all used to. But I'm going to show you a different way. Having your income deposited into that checking account is actually having you miss out on a second opportunity. So, what if we can make your paycheck work harder for you by keeping the same income, the same expenses, but have a different structure for your finances? So, this is a different strategy setup, a different way to flow your money using the offset way. This is the offset strategy, strategy number one. You have your paycheck that comes in and it goes into an all in one account. So, instead of having your checking account, your savings account, and your mortgage slash line of credit separate, it's flowing into one account that is all combined together. And I'm going to show you the numbers here specifically for the Johnsons and go through the flow here again. So if this doesn't make sense yet, it hasn't clicked, that's okay. We're going to go through this several times. So reviewing the Johnsons' current monthly cash flow, here's what it looks like. They've got their monthly net income, so $250 a year netted out after paying income tax. They've got $15K every month from the two of them. Their monthly expenses are $13,175, and that's including the mortgage payment. So expenses like their groceries, subscriptions, everything, all included, $13,175 a month. Positive cash flow of $1,825. So at the end of every month, they're left over with $1,825. So using that, flowing through the offset strategy, their biweekly paycheck hits. So again, that $15K divided by 2 because it's biweekly. That paycheck hits $7,500. That goes into the all-in-one account. So that includes the mortgage and line of credit here. So with that, you start off with that $700K balance. And on day one, it knocks that $700K balance down to $692,500 because again, it's that $7,500, reduces the balance there. And this is crucial. It happens on day one. It happens automatically because the income flows through that. And the interest is calculated on the $692 here instead of the $700K. And that's the biggest difference here is your mortgage is calculated on the outstanding balance, but as soon as we knock that balance down, you're paying less interest on day one. And that's how the offset mortgage strategy works. So let's go through the numbers again. So on day zero, your mortgage balance starts at $700K. On day one, the paycheck comes in, reduces the balance. Then day 2 to 14, you have expenses to pay for, which is normal. That's okay. You're going to pay those expenses throughout those 2 to 14 days. And the expenses are $6,587. Day 15, the paycheck hits, and so on and so forth. You can see the balance is gradually decreasing. Sure, it goes up from here, but look, it's still lower than the initial balance, and it's dropping every time the paycheck comes in, and you'll see it just starts to flow down here as time goes on. So in the first 60 days of that mortgage, if they had a traditional mortgage, the balance on that after 60 days would be $697 using the regular mortgage payments. If they had it set up with the offset strategy, their balance would be $693,000. So that's a difference of $3,457 which I know is a big difference, but you might be looking at that like, it's not a huge difference. But if this is the first 60 days, so when you add this up over time, it is a dramatic difference. And I'm going to show you the numbers long term here. So going back to their renewal offer, here's what's on the table from their bank. We already discussed that. Those are the numbers. We're going to compare the traditional mortgage to the offset strategy. So here's the traditional mortgage, 25-year AM, 700K, got a 5-year term. Monthly payment on that is $3,862 with that interest rate of 4%. And year saved zero, payment saved zero. Offset strategy, we've got mortgage amount 700K, 25-year AM, same thing, 5-year term. Payment is actually slightly lower. And I'll explain why that is in the future. Just keep in mind, it's either going to be relatively the same, maybe slightly higher, or slightly lower. It's going to be very similar, if not always going to be the same. In this case, it actually is lower, and that's because a portion of this is structured in a home equity line of credit. And I don't need to go into the detailed numbers there to try to confuse you on the different setups we can do. Just know that the reason why this is slightly lower is because a portion of their mortgage is in a line of credit, which is interest only payments. So the rate is actually higher. And the reason for that is because with your renewal offer from your bank, typically it's going to be the lowest rate out there because they want to retain you as a client. It's more expensive for them to pay us, mortgage brokers, to acquire clients. So they want to retain as much as possible. So they're going to offer you a slightly lower rate than what you can get elsewhere, usually. So that's why I put in a higher rate here, 4.14. Years saved with the offset strategy, you're saving 9.25 years just from having your income flow in. Payment saved, 407,000. And that's all without increasing your monthly payment. Okay, so I'm going to start with the offset FAQs. Number one, can I get this with any bank? So you can duct tape this strategy with another bank. Just keep in mind the Manulife One product, which is where we put the offset strategy in, is the only product that is fully automated to what we need. Oftentimes, what I found is when someone tries to duct tape the offset strategy on their own, they usually give up because there's a lot more additional steps for them to take with transferring the money from their income into their line of credit and going through that every single month. And they usually give up. Whereas the Manulife One product is that fully automated product, which is why we use it. Number two, how is this different from just making extra mortgage payments? Well, you're using the cash flow timing. So you're not using bigger payments. You're not increasing the payment. You're not reducing the amortization to start off with. Your money isn't locked up. That's why this strategy is so nice, because it gives you that flexibility. If cash flow ever reduces down the line, or you wanted to contribute more to investments, you have the flexibility with the offset setup. It also works automatically when the money's deposited into the account on day one. So the interest that you're paying is reduced on day one. Even a temporary balance reduction really saves you over the long run. And I didn't even get into explaining some other advanced strategies that we can layer on with the offset strategy, like just a little teaser, like the sweep method, where you would basically put all of your expenses on a line of credit, or sorry, on the credit card, and you wouldn't pay those expenses off until the end of the month to keep the balance on the offset account as high as possible for as long as possible. Then you pay off your credit card on day 31, and then on day 1 in the new month, you rinse and repeat. So that's a sweep method. That's just something we can layer on as well, not to confuse you. Do we put the full mortgage amount in a HELOC? Absolutely not. This is kind of a pet peeve of mine. You have other brokers out there in the industry. To give you some context, the first video that went viral for me was talking about the offset strategy, and that really sparked a lot of other brokers to start talking about it and promoting the product and the strategy. And some were well suited to be promoting the offset strategy, whereas some they didn't really know it through and through. And that was a problem that a lot of people in the industry had, was all these brokers already just started promoting the product out of nowhere. And that led some brokers to talking negatively about the product and how some brokers are putting people into full line of credits, which is not how you set it up. You only put a portion of that mortgage amount into a line of credit, and that's calculated on the back end. We do that, and we determine what that amount is. And for the Johnsons, for these numbers, that amount was 50K. For you, it might be a bit different. It might be 40K, it might be 30K. But because their cash flow was on the higher side of 1,800, we start off with a higher line of credit amount. But absolutely not. You're not putting that 700K into a giant line of credit. And then we do annual check-ins to rebalance that line of credit account. So why doesn't everyone do this? It's not commonly taught or advertised. And I mean, there are more brokers promoting it, but it's still not a common structure that most Canadians know about. But it is common in other countries. For example, our counterparts in Australia, they're the most similar to us than any other country. They actually, this is their default.